A retired couple in Arizona took in about $80,000 this year, spent it, paid bills with it, took a trip, helped a grandchild, and when they file their taxes next spring, the IRS is going to count almost none of it as income. Not deferred, not reduced, simply not taxable at all. And every dollar of it is written directly into the tax code in plain sight. There is an entire category of money the tax code does not treat as taxable income. And today I am walking through 7 different types of it, some of it building on ground we have covered before on this channel, like the 0% capital gains window and how Roth withdrawals stay invisible to your Social Security taxation, and several of it brand new, including one rule almost every retiree assumes could never possibly apply to them, and they are wrong about that. Sometimes it is the single biggest number on this entire list. Stay with me to the end, because most retirees know one of these 7, maybe 2, and spend their whole retirement paying tax they never actually owed. My name is Robert Hensley, and every week I go through the actual tax code, the actual IRS publications, and the actual rules on these accounts. Because nobody ever sits a retiree down and lists all of this out in one place. It is scattered across different sections and different forms. And that is the only reason most people know one type of tax-free money and miss the other 6. Hit subscribe and turn on notifications, because several of these figures are current for 2026 specifically, and they shift every year. One quick housekeeping note before we start. If you have watched my videos on the 0% capital gains bracket, or how Roth withdrawals protect your Social Security from taxation, the first 2 items on this list will feel familiar, and I am moving through those quickly to spend the real time on the 5 you likely have not heard covered here before. Quick recap on the first one. A traditional IRA or 401k taxes every dollar coming out, but a Roth account works the other way. You pay tax going in, then it grows and comes out completely untaxed. And that includes when your children eventually inherit it. What is worth restating is why this matters so much more than people realize. A Roth withdrawal does not count toward the combined income calculation that determines whether your Social Security gets taxed. And it does not count toward the income Medicare uses to calculate your premium surcharge, which I covered in detail in an earlier video on the Widow's Medicare cliff and the SSA 44 form. A traditional withdrawal touches both of those. A Roth withdrawal touches neither, and a Roth has no required withdrawals during your lifetime at all, unlike a traditional account, which forces money out starting at 73, whether you need it or not. If most of your money sits in traditional accounts right now, the real move is converting some of it during your lower income years. And that is worth its own conversation with a tax professional. The second one, also familiar if you caught my earlier video, there is a 0% bracket for long-term capital gains. And for 2026, if your taxable income stays at or below $49,450 single, or $98,900 married, your investment profit is taxed at 0, not deferred, 0. Here is something I haven't walked through before that turns this from a one-time move into a strategy you can repeat every year. After you sell an investment to capture that gain at 0%, you are allowed to buy the exact same investment right back the very next day. There is a rule called the wash sale rule that makes you wait 30 days, but it only applies to losses. It does not apply to gains at all. So you sell, you immediately buy it back, your cost basis resets at the higher price, and you have permanently locked in that appreciation at a tax rate of 0. Do that again the next low-income year and the year after that, quietly resetting your basis upward for free every single time you have room under that ceiling. Now, let us get into noob round, starting with the one that causes more confusion than almost anything else in the tax code: money someone gives you. If someone gives you money, you owe 0 income tax on it, ever. It doesn't matter if it is $500 or $50,000. Receiving a gift is simply not taxable income to the person receiving it. That is written directly into the tax code, and it is not a gray area. So why does everyone think otherwise? Because of one number that gets repeated constantly and misunderstood almost every time: $19,000 for 2026. That is the annual gift exclusion, and people hear it and assume it means they can only receive $19,000 before getting taxed. That is not what it means at all. That number has nothing to do with you as the receiver. It is a reporting threshold for the person doing the giving. Your child or a friend can give you up to $19,000 this year, and nobody files anything. If they give you more than that, they still do not owe tax. They simply file a form, and the excess counts against their own lifetime exemption. That lifetime exemption for 2026 is $15 million per person, $30 million for a married couple. So unless the person giving you money has a $15 million estate, no gift tax is ever actually paid by anyone. It is a form, not a bill. Now flip this around, because it works in both directions, and this is where it gets useful for you. That $19,000 figure is per person per year, with no limit on how many people you can give to. So a married couple can give $19,000 each to a child, and another $19,000 each to a grandchild every single year, with no forms and no tax on either side. And there is an exception almost nobody has heard of. If you pay someone's tuition or medical bills by paying the school or the hospital directly, not the person, there is no limit at all. It does not count against the $19,000, and it does not touch your lifetime exemption. You could pay a grandchild's entire college tuition completely outside the gift rules. The only condition is the check goes straight to the institution. One honest boundary before we move on, because I always want to give you the edge of the rule, not just the middle of it. Gifts are invisible to the IRS, but they are not invisible to Medicaid. If long-term care might be in your future, Medicaid looks back 5 years at money you gave away, and gifts can create a penalty there, even though the IRS does not care at all. So the tax answer and the Medicaid answer are two completely different answers. Know both before you give large amounts. Now let us talk about the money you inherit, because it follows a similar principle to gifts, and it comes with one of the biggest traps in this entire video. A trap that can turn the exact same inheritance into either a tax-free windfall or a serious tax bill, depending entirely on which account it came out of. Money you inherit is generally not taxable income to you. If you inherit $200,000 in cash, you do not report it as income. If you inherit a house or a brokerage account, receiving it is not a taxable event, and there is no federal inheritance tax in this country at all. It gets better because of a rule called the step-up in basis. When you inherit an asset that grew in value, your cost basis resets to what it was worth on the day the person died. Picture parents who bought a house decades ago for $60,000, worth $400,000 when they pass. Normally, selling something that grew by $340,000 means a large capital gains bill. But because it was inherited, the basis becomes $400,000, the current value. Sell it for that amount, and the taxable gain is zero. A lifetime of appreciation simply erased. The same rule works on inherited stock. And here is the one major exception, the part where families genuinely get caught off guard. An inherited traditional IRA or 401k is fully taxable. That money was never taxed on the way in, so the IRS collects when it comes out, and your heirs generally have to empty that account within 10 years, paying ordinary income tax on every dollar, often during their own peak earning years when their tax rate is highest. Picture a woman named Winifred who left her 2 adult children $200,000 each, one in a regular brokerage account and one in a traditional IRA. Her daughter, who received the brokerage account, got the step-up and sold it owing almost nothing. Her son, who received the traditional IRA, had to withdraw it within 10 years and handed a significant share of it straight to the IRS. The exact same amount of money, wildly different outcomes, decided entirely by which account it came from. If you are charitably inclined and holding both types of accounts, there is a clean move. Leave the traditional IRA to charity, which pays no tax on it at all, and leave the Roth or the brokerage account to your children. One state-level note before we move on. While there is no federal inheritance tax, 5 states still have one: Kentucky, Maryland, Nebraska, New Jersey, and Pennsylvania. And rates often depend on how closely related you were to the person who passed. So if you live in one of those states, or you are inheriting from someone who did, check your state's specific rules. Now let me show you the only account in the entire tax code that manages to do 3 things at once, and most people who have one are only using about 1/3 of what it can actually do. It is the Health Savings Account, the HSA, and here is what makes it genuinely unique among every retirement account that exists. Money goes into an HSA without being taxed. It grows without being taxed, and it comes out without being taxed as long as it is spent on qualified medical care. Every other account gives you 2 of those 3 at best. A traditional 401k gives you the deduction going in and tax-free growth, but taxes the withdrawal. A Roth gives you tax-free growth and withdrawal, but no deduction going in. The HSA is the only one that gives you all 3. Here's the strategy that changes everything. There is no deadline to reimburse yourself from an HSA, none at all. Picture a man named Delbert who pays a $400 medical bill out of pocket today and saves the receipt. He can reimburse himself from that account 5 years from now or 20 years from now, completely tax-free whenever he takes it, as long as the expense happened after the account was opened. By the time Delbert is deep into retirement, he has years of accumulated receipts, which function as a tax-free cash reserve he can draw on at any moment for any reason, and the IRS never sees a dollar of it as income. Here is the part that matters most for anyone on Medicare. After you turn 65, HSA money can pay your Medicare Part B premiums, your Part D premiums, and your Medicare Advantage premiums completely tax-free. That is a bill nearly every one of you is paying, most likely straight out of your Social Security check, with money that was already taxed once. Paying it from an HSA instead means paying it with money that has never been taxed and never will be. Two honest boundaries. To contribute to an HSA, you have to be enrolled in a qualifying high-deductible health plan. And once you enroll in Medicare, you can no longer contribute, though you can absolutely still spend what is already in there. And after 65, if you pull HSA money out for something that is not medical, it is taxed like a traditional IRA withdrawal. No penalty, but it counts as income. Spend it on medical care, and it stays completely untouched by the IRS. One more type worth knowing, and I am including it because it comes with a trap that most videos on this topic leave out entirely. And the trap is the part that actually affects you. When you lend money to a city, a state, or a school district by buying a municipal bond, the interest they pay you is exempt from federal income tax. And if you buy bonds issued in the state where you live, that interest is often exempt from your state income tax too. People call that double tax-free. Here is the trap. Municipal bond interest is exempt from income tax, but it gets added straight back in when the IRS calculates whether your Social Security gets taxed. Remember that combined income number from earlier, with the frozen $25,000 and $34,000 lines. Tax-exempt interest counts toward it on purpose. Congress wrote it that way specifically so people could not use municipal bonds to sidestep the Social Security calculation. So a retiree can buy municipal bonds believing the income is completely invisible, and the interest itself really is never taxed, but it quietly pushes their combined income over the line, and a chunk of their Social Security becomes taxable anyway. The honest way to use this one: municipal bonds are genuinely excellent if your income sits comfortably above those Social Security thresholds already, or comfortably below them with real room to spare. The tax-free interest is real money. But if you're sitting right near one of those lines, municipal bonds can cost you more than they save. Run that math, or have someone run it before you load up on them. That covers the trap most people never hear about. Now let me close with one more piece that ties directly back to something we have covered before: the home sale exclusion, because there is a specific rule for widows and widowers that most people miss entirely, and the timing on it genuinely matters. If you already know that selling your primary home lets you exclude up to $250,000 of profit single, or $500,000 married, here's the piece that is new. If your spouse has passed and you sell the home within 2 years of their death, and you have not remarried, you can still claim the full $500,000 married exclusion, instead of dropping down to the smaller single one. Combine that with the step-up in basis we just covered for inherited property, and a surviving spouse selling the family home can often owe nothing at all on a sale that would otherwise trigger a serious tax bill. But that larger window closes exactly 2 years after the death. So the timing is not flexible. It is a hard deadline. And one more thing worth digging your old files out for. Money you spent improving the home over the years gets added to what you originally paid for it. A new roof, an addition, a remodeled kitchen. Every one of those raises your basis, which shrinks your taxable profit if you ever go above the exclusion. So here are the 7 quickly. Qualified Roth withdrawals, invisible to your taxes, your Social Security calculation, and your Medicare premium all at once. The 0% capital gains bracket, which you can reset year after year, since the wash sale rule only blocks losses, not gains. Gifts you receive, never taxable to you. And that $19,000 number is the giver's paperwork, not your limit. Inheritances, generally not taxable income, with a step-up that can erase a lifetime of gain, except for an inherited traditional IRA, which is fully taxable within 10 years. The health savings account, the only account that gives you all 3 tax advantages at once. Municipal bond interest, genuinely tax-free, as long as you respect the Social Security trap hiding inside it. And the widow's 2-year window on the full home sale exclusion, easy to miss and impossible to get back once it closes. This is general education, not personal tax advice. Confirm your own numbers with a qualified tax professional before making a big move. And never act on advice from someone who calls you out of the blue claiming to be from the IRS. The real IRS contacts you by mail. If you know a parent, a spouse, or a friend this could help, share this video with them today. And if you have got a question about your own situation, drop it in the comments. Every Friday, I answer real viewer questions over on my post tab. This channel provides educational information only and is not affiliated with the Social Security Administration, Medicare, CMS, the IRS, or any bank.